Tonight, we're going to talk about Trump's victory and what that means, veterinary industry growth, which is slowing, and sort of where we are as an industry and how this all works. And Ryan's going to do a few intro slides, and then I'll get to the meat of it.
Yep. So thanks everyone for joining. If you have any questions, there's an icon at the bottom of your Zoom screen. It allows you to ask questions. Feel free to ask them as we go along. We might not get to every single question, but for people who have questions, if we don't answer them tonight, we'll definitely have a chance to follow up with you one-on-one after the webinar. Also, Rich is going to drop a link in the chat box to his schedule. So if there's anything that you want to discuss one-on-one with him after, whether it's about your clinic, the industry, really anything about the vet space, feel free to schedule time with him, and he'll be dropping that link in the chat box. So who is Ackerman Group? So Ackerman Group, and you should just see that link to his schedule dropped in the chat box just now. So who is Ackerman Group? We're a veterinary broker, so we focus exclusively on the veterinary industry. It's all we do. We are actually the largest broker of veterinary practices in the United States. In a given year, we'll sell anywhere from 40 to 80 clinics in a year. So that's a little bit around 1 to 1.5 clinics a week. The reason why that's really important is none of the data about the veterinary industry is publicly available. It's not like buying or selling your house where you can just go on MLS or go on Zillow and see what your neighbor's house sold for or the house down the street sold for a week ago. What we have is industry-leading data from the 225 plus clinics we've sold over the last couple of years, over $2 billion in headline value, and a huge amount of diversity in the types of clinics that we've sold. Everything from joint ventures to 100% sales. We work with almost every single corporate buyer in the United States, and there are about 60 of them. So we have really deep knowledge of who's buying, at what prices, and what terms. And we're going to talk a little bit about what's going on in the industry later in the show. So Rich, you want to go to the next slide?
Yep.
And then before I pass it off to Rich, I want to share a little bit about our team. So in addition to selling the most clinics in the US and now Canada, we also have the largest team focused on your success as a practice owner. So everyone from client-facing people like myself, Rich, Roger, who is a practicing DVM, to financial analysts, some of whom worked for some of those corporate buyers that I was just alluding to. We have people who used to be practice managers, vet techs, helping with due diligence and financial analysis, and then getting you all to attend these webinars and talk to us on our marketing team. And so I want to hand it off to Rich Lester, who's our CEO and who was previously a founder of one of the early consolidators of the industry. But Rich, I'll leave it to you to introduce yourself and take the rest of the content from here.
Thanks, Ryan. I appreciate that. Welcome, everyone. And I'm excited to talk to everyone tonight. And I'm going to make one quick comment. We usually do these webinars once a quarter. We did something right before the election in October. And I think with the election results, with Trump's victory, the Republicans sweeping the House and Senate, there's a lot of uncertainty, and we wanted to just sort of provide perspective. So that's why we're doing this webinar sort of at this unique time. And so why am I qualified to talk about the vet industry and what's going on? I've been in this industry now for about 16 years, started back in 2008 at Brightheart Veterinary Centers, which was an early consolidator. Then I was the founder and CEO of Veterinary Practice Partners, which is a group that I grew to about 65 hospitals, 1,200 employees. I stepped down in 2020, took some time off, and then joined the Ackerman Group. And as a leading advisor and broker, I think I'm one of the only folks who's sat in the buy side as a CEO making decisions on buying a lot of clinics, and that helps me with advice when we're looking to advise sellers like some of you may be. So anyway, that's my background. What are we going to talk about tonight? First and foremost, I'll start with the US economy and what's happening. Inflation data came out this morning, which I can talk to as well. Then we'll talk about how the economy is going to be potentially impacted by Trump's administration. And then we'll talk about the veterinary services market. And in our view, it's at a very unique inflection point where things are going on that we'll explain, and we'll give our advice around how to handle those things. And then we'll present a bunch of the data that Ryan was talking about what we're seeing real time in the market today, so you understand why we think it's actually a pretty attractive time to sell. Then I'll summarize and we'll take questions. So what's going on with the economy besides interest rates finally declining after being up for a long time? So this is a chart I've been showing for the last 2 to 3 years that we've been doing these webinars. And I guess the way I would put it, hopefully you can see my cursor, the orange line is inflation, the blue line is interest rates. And so you can see inflation peaked back in 22, and the Fed started raising rates a little bit late. But once it started raising rates, things that you'd expect to happen happened, which is inflation started to come down. And as inflation has come down, the rates plateaued for over a year. And higher interest rates lead to lower inflation because higher interest rates pull back or slow down economic activity. And I'll go back in time and give you just a quick summary of why did prices go through the roof, which is what inflation's all about. And if you remember during COVID, a number of things happened. One, it was hard to get goods into the country because China was shut down, manufacturing there was shut down. So there was a shortage of product, but yet the government, as part of the Inflation Reduction Act, was handing out money to people, both businesses in PPP loans that many of you got, as well as checks to individuals. And that created a lot of demand, but there wasn't a lot of supply of goods. And that drove prices up. And then the Fed reacted, raised interest rates, and inflation has started to come down. And inflation has steadied itself in sort of the 3 to 4% range. And then in the last 6 months has finally gotten below 3%, but not quite at the 2% level that the Fed thinks works long term. In the last 3 months, the Federal Reserve has lowered interest rates from over 5% to now just over 4.5%. And there's an expectation in December that rates will come down again. And so the way I put it is the interest rate policies are working. It's slowed the economic growth a little bit. It has reduced inflation, not quite to where we want it, but we're seeing the types of things that bode for a good economy. And the other slide I'll show is how interest rates and growth, or GDP, gross domestic product growth, have been working in tandem. So during COVID, GDP went through the roof at certain points in time because there was all this demand. At the beginning of COVID, it went down because we were all sheltering in place. Then as we weren't sheltering, all of a sudden activity spiked, and then it's come back down to sort of normal ranges. And interest rates, as they start to decline, it'll be interesting to see if economic activity picks up even more. One of the big things that has been a concern is how is the job market, and all of you have had issues with hiring veterinarians and hiring staff. I think relative to the COVID time in 21 and 22, things have improved. They're still not easy in our industry, but they're certainly better than they were 2 or 3 years ago. And so what's happened to what will happen to the economy is going to be a really interesting question based on what types of policies the Trump administration puts into place. And as I like to say, right now there's a lot of uncertainty in the world. There's uncertainty around the world with domestic policy and the economy. And the only certainty that I know of or I can speak to is that we're in an uncertain environment. And what are some of the some of the specifics around that uncertainty? Well, if you look around the world, things aren't so stable. While the Russia-Ukraine war has been going on for now 2+ years, that still creates some instability. The Middle East over the last 2 weeks has become way more unstable with Assad's regime falling and unclear who's going to run Syria. And does it become like Libya, Somalia, Sudan, where there's sort of no real functioning government, or will something come into play? It's a strategically, Syria is a really important country, so having it in a shambles or without a government will be challenging for a lot of people. And then obviously the Israel conflict with Hamas and Hezbollah continues. And so we view the world that we're entering or moving into the Trump administration, the world's pretty unstable. Domestic policy, I'd say my only description of it is on the sort of economy side, he's picked pretty traditional Republicans who are going to try to lower taxes, keep the economy moving, and deregulate the economy, which helps business growth. But a lot of the other cabinet picks outside the economic team are probably going to create some disruption in the government. And I'll talk more about that in a few minutes. And where are we from a economy standpoint? Right now, it feels pretty good. GDP is going well, inflation's coming down, short-term interest rates are declining. The long-term rates or the 10-year treasury has gone up, which isn't good for the government when we're borrowing money. It isn't necessarily good for home buyers, but it's signaling that there's concern about sort of long-term deficits and long-term inflation. So there's a bunch of uncertainty in the world around us. What does that mean and what's going on in our industry specifically? Well, our industry specifically has been under some challenges, and this is really one of the things that concerns me as a investor, business person in the vet space. So if you extend this graph back to 2010, 2011, one of the things that attracted a ton of private capital, all these private equity companies in the 2010s, was the steady, stable growth of the industry. We had very predictable from 2011 to 2019, approximately 1% invoice growth and approximately 5% revenue growth. And during that 2010s timeframe, the US economy was growing 2 to 2.5%. So the industry was growing at double the economy. So we were taking a bigger share of people's wallets, and we had steady, stable, predictable growth. And that led to a ton of investment capital coming into the industry. Then during COVID, we had a small dip in demand and invoices, and then things took off like a rocket ship for really 18 months or so. And we had unbelievable spike in demand, in invoices, and revenue. People raised prices because they couldn't handle all the demand. And now, as things have settled down in 2022, this is the real problem we're having. Invoice growth for the last now 11 going on 12 quarters has been negative. And so invoices are now shrinking 2 to 2.5% the last 3 years. That does help with the labor shortage. If we're doing less invoices, it helps with the labor shortage. But from an investor standpoint, if you typically want to invest in an industry that's growing organically, not just through price. And so for 3 years, the only growth in the industry has been through price. And when I talk about whether we're at an inflection point in an industry, I'm talking about if we get a fourth year of invoice declines, does the investment capital start saying, this industry is a little different than we first invested, and should we value these businesses as highly as we do? if invoice growth or fundamental growth in the industry isn't going to happen anymore. Um, a lot of people will argue that the 3 years of invoice decline is really just a reaction to this really high growth that we had during COVID. And after 3 years, you can still say, hey, this is a cycle and we haven't come out of the cycle. I think if we have a fourth year in 2025 of invoice declines, there's going to be real concern from investors about the long-term trajectory of the business. And I say that the industry is at an inflection point because while invoice growth is down, we're seeing all of a sudden over the last year multiples that are being paid for individual practices going up. And growth in multiples, growth in valuation when the industry is fundamentally declining, that's a rare thing. And so for the first time in 7 or 8 years that Ackerman's been in business, we have been advising clients, hey, if you're going to think of selling your practice in the next 2 years, you may want to think about doing it now. And this is sort of the summary of what I've just talked about. We've had the invoice decline. Despite the invoice decline, we're seeing multiples, especially for those practices over $500,000 of EBITDA or more. Those multiples are going up. And some of you will say, well, why is that happening? It doesn't sound right. And the reason that multiples are going up is partially because of what's happened in the industry for the last 2.5 years. And basically, the way we think about it is in 2021 and early 22, there were a lot of what are called recapitalizations, where the investors who own the corporations sold those corporations and made a bunch of money. And that happened in 2021 and early 22. Then there was really a 2.5 year pause because interest rates went up a lot. No one was doing any recaps. And so there's like all this pent up demand by investors to sell their practices, sell their businesses, or sell the consolidators and cash out. Just last week, we had the first major deal close in the industry in really 2.5 years when SVP and MVP merged and Silver Lake Partners invested new capital into the business. That was the first major recap. There have been smaller businesses that recapped, but that was the first major one in 2.5 years. And so when folks are thinking and preparing to recap, they want to build their pipelines and they want to do a lot of deals. And so we're seeing a lot of deals happen, and that's driving pricing up in the short term, despite the industry fundamentals not looking good. And so this is partially why our advice has been before the election, even if you want to sell in the next 2 years, now may be a good window. And when you add and layer in the Trump's election, our view is actually, while he is going to certainly be a disruptor, it's really unclear what's going to happen over the next year or two with the economy. There's a lot of arguments that people will make that he's going to drive economic growth and the economy will boom. I would argue that there's a bunch of data points that agree with that, meaning he's going to reduce the administrative state and regulations, and that's a clear priority. That's going to make things more business friendly. But there's also people in his realm, including JD Vance, who are saying, hey, big business, we need to regulate it. We need to prevent mergers, that tech companies have too much power, et cetera. So the agenda is not completely clear. And then some of his policies could be clearly inflationary, i.e., deporting a lot of immigrants will exacerbate the labor market. Tariffs could drive price increases up. And so at the end of the day, there's a lot of talk that it's going to be a really positive next year or two during the first couple of years of his presidency. I would argue, I just have no idea. And it's really hard to say. And as I said earlier, the only certainty I know is that there is uncertainty. And I think over the first month or two after his inauguration, there'll be a lot of signals about what's going to happen, and whether he's going to focus solely on the business friendly pieces of his agenda, or if he's going to have a mixed bag of business friendly and not business friendly pieces of the agenda. My guess is he's going to be consistently inconsistent and focus on both pro business and some non pro business things. And so our view overall is that valuations, there's a bunch of uncertainty, just like with the economy. And so I think we will have a lot more information comes February, March, when we see how the first sort of 90 days go. But if our view is that if you're thinking of getting out, it's a really good time right now because valuations are up and things outside of the, I'm going to call it general economy, are driving valuations. It's the desire to recap that a lot of the big corporations in the industry are buying practices now, and that's driving valuations in a positive way. Probably the only certainty or thing I can say with a lot of confidence is that taxes will stay low and are not likely to go up under the Trump administration. So there was tax cuts that were put in place in 2017. They all expire at the end of 25. The likelihood with Congress solidly in Republican hands that those tax cuts get extended, we think are really high. We think individual rate increases will not likely happen. The SALT deductions may go away. I think we're going to see a lot of positive things on the tax front, and most importantly, we don't think there'll be any changes in capital gains taxes. So overall, again, before I go into the market trends, I think what we're seeing is an industry set of issues that say industry is underperforming. The valuations are going up while the industry is underperforming. And the other point that I'm going to make about the invoice growth that I forgot to make a few minutes ago was you when you read the reports, the earnings reports from businesses that the retail businesses that deal with individual consumers, companies like Target, Amazon, Home Depot, Walmart, all of them in their third quarter earnings reports talked about the average consumer being conservative and not spending as much and being leery of overspending. And when those companies servicing I'm going to call it the average American, are worried about spending, the likelihood that we see invoice growth go up in 25 feels low to me. In the nicer and higher income areas, I think invoices will continue to do fine because people with money will continue to spend. But across the country, 95% of our citizens seem to be watching what they spend, according to a lot of the big retailers that service them. And that makes me leery of what's going to happen in 25. So market trends. I put this slide up before, but this is the most important market trend is we're seeing valuations go up. This is on the left axis, this is the average multiple. We saw pre-COVID multiples go from the 7-8 range to the low double digits on average pre-COVID. They spiked to the mid double digits to 14, 15. That's the average. We saw deals as high as 18, 19 times EBITDA in 21. Then they came back down to sort of pre-COVID levels, and now they've marched up again. There's no reason to expect that they're going to get back to the pre-COVID levels or the COVID levels, but they're at very robust places right now. On top of that, we're seeing deal terms that have become more and more friendly to the seller right now. And This is a really important slide where we're showing how much cash is paid up front for a deal. Is it less than 60% of a deal, 60 to 70% in cash, or over 70%? And you can see that in 2024, we're seeing way more cash versus prior years. And we're seeing virtually no one getting less than 60%. And 3/4 of the folks are getting 70% or more cash at close. And most people, if they're selling, want to de-risk and put cash in the bank and invest it in the stock market or elsewhere. And so having this big jump in cash up front is really attractive to a lot of sellers that we're seeing. And this next slide is talking about the simplification of deal structures. And so the blue bars are deals that have earnouts where there's money contingent on performance. The orange bar are joint ventures, and the purple bar is top co-equity or investment, taking some shares in the parent company. And in 21, 22, and 23, a lot of deals had multiple pieces of structure, and people were really trying to conserve cash. So they gave folks both earnouts and JVs, or both a JV and top co-equity. And now we're seeing deals simplifying where the number of structural elements is more likely just one, not two elements. And that's also leading to more cash. And so we view simpler as better for most sellers. There's upside in some of this structure, but it's also riskier. And so the market's getting more heavily cash, more simple with less structure. And then this is a complicated slide, but I'll explain it. This is who we're selling practices to. And I haven't updated this for a couple of weeks because there's a lot more buyers that we've worked with over the last couple of weeks. But anyone in blue is a buyer that we have never worked with before. And then in orange is buyers that we've worked with before. And so what was really interesting to us is that obviously in 20, there were lots of buyers. In 21, we sold to lots of different groups, but there wasn't a lot of new players in town. Suddenly in 23, we've seen 7 new buyers show up. And in 24, this 3, I think, is now a 4. And there's just new players and new activity coming in. And so why is that important? One is, if you're thinking of selling your practice and you're going to do it on your own, do you know who all these new buyers are to talk to? A lot of them are smaller groups that aren't out there as much. And then I can assure you that the groups that were most active in 20 and 21, many of them aren't active now. And those that are active are groups that, your friends who sold in 21 and hit the peak didn't know of or didn't hear of. And there's like this new crop of buyers out there that are talking to people. And so having some advice and understanding what's going on in the market's really important. So that's the data set that we offer tonight. Wrap up on 2 things, just a quick, anyone who's thinking about potentially going to market and selling, we've started to show this slide to discourage folks, to be frank, from doing it themselves. Advisors like us and our competitors, we do charge a fee, but we provide a lot of expertise. And what we talk about is the folks who are buying clinics. Usually you talk to a business development executive who's like a really nice person, develops a relationship with you. But reality is there's a whole slew of people behind the scenes figuring out how to structure a deal, how to create terms that are favorable for them, not for you. Even though the business development exec is your friend, there's a lot of detail in these deals that aren't so, I'm going to call it, friendly to the seller. And sellers who do it themselves without a lot of experience, and especially those that don't use someone with a lawyer without a lot of experience, typically don't get the best deal terms, they may get a nice valuation, but then the terms, and there are 10, 20 different key terms in every deal, you want to make sure that you have the right representation to help you with it. So that's the little pitch for if you are going to sell, use an advisor. We want you to use us. But if you don't use us, definitely use someone who's capable. It will be worth it to you. And so finally, before I take questions, quick summary. The economy really has stabilized. Interest rates have started to decline. Long rates are going up. We likely see a soft landing with the economy. We don't see a recession next year. The stock market's been going up. Long-term interest rates have been going up. The vet market's been struggling. Invoice growth just hasn't been there, but valuations have been ticking up and buyers are providing more cash. And so we talk about this inflection point, and if you're thinking about exiting or selling in the near future, now's a really good time given the risks on the industry. And I think my prediction is if we get back to invoice growth in 25, all will be well and there's nothing to worry about. But if invoices don't start growing this year, overall, I think you'll start to see buyers getting more stingy on purchase price late 25, early 26, because they're worried about invoice growth and when that will return. So that's the quick summary. All right, that's what I have to say tonight. We're going to open this up to questions for those of you who are here. I think, as Ryan mentioned, there's a Q&A function in your, I went dark there. There's a Q&A function in what you have, and please go take a look at that. And if you have questions, put them in, and I've got to figure out how to access them. Here we go. All right, let's start with the questions. So Joe asks, is there an opportunity to purchase a clinic from a corp, especially one that is not doing well? How would you approach the corp? I've done it and gotten no response. I would say, Joe, that is a challenging thing to do. Most corporations are not in the business of selling back clinics. We've seen it happen very occasionally. And I would say if you're not getting a response, set up a time with me. We'll see if we can help. It depends on the corporation. It'll depend if you were the selling doctor or not. There's a lot of things that'll go into that. So we're happy to help you. It happens, I would say, just very sporadically. Then second question was, what do we think about the economy in Canada? It's a really good question. I'm not gonna sort of BS my way through this one. I haven't spent as much time as I should studying and learning about the economy up in Canada. I think it a lot of times mimics ours to a lesser degree, but I'm gonna make sure I have an answer for that in our first quarter webinar, our year-end webinar, which we're going to do in February. So I'm going to punt on that one, which I don't usually punt on too many questions. All right. An anonymous attendee asks, the expected gross income this year will be less than last year for my practice. It's a first decline since 17. I'm a solo practitioner. I've not been able to find any associates without lack of effort. I'm actually getting sick of trying to find associates and thinking of selling this, although I know 2 FTE would be ideal to fetch more price. Should I go for it? I think, and we get this all the time, one doctor practices are not typically purchased by corporate groups. They will, the exceptions would be if you're in a really good market, you know, the Atlantas, the Phoenixes, New York, Chicago, Dallas, Austin. If you're one doctor in a really good market and you have a building that can support 3 or 4 doctors, we might be able to find someone who has a little bit of interest. And by the way, you need to be doing at least $1.5 million as a single doctor. If for a corporate to buy, a corporate won't even look at $1 million individual, one doctor practice. The most likely better option is to go to a a broker that helps in the doctor-to-doctor sale market. And again, you can email myself or Ryan, and we can point you to folks that help in that market. All right. Next question. Jordan asks, what do you think the public markets will value the first and other early groups that IPO? SVP, MVP talk about going public. Will the public markets pay a higher price than a private equity group? That's a really good question. I wish I had a crystal ball. What I would tell you is that a well-run, predictable meaning that a well-run, publicly traded veterinary company should trade at a significant EBITDA multiple. But the fact is we don't have a lot of history, and I'm going to be very blunt about this. The last publicly traded veterinary services company was VCA, and VCA always traded at a bit of a discount. And there was a reason for it, because VCA's same store or same clinic growth and their invoice growth year over year was always below market. And so there was data that said the market was growing 1% from an invoice standpoint, and VCA every quarter would come out, we're flat, we're down a half, and the market was up. And so they always traded at a low multiple. SVP, MVP would say that they're growing at above market rates, that they're not shrinking invoices, that they have growing invoices. And so public markets value predictability and outperformance. And so while the private equity folks really look at acquisition and growth through acquisition, the public markets are more focused on, are you generating same-store growth? Are you getting more invoices in? And they'll look to see maybe not lots of little deals, but a big deal or two here or there. So I think there is a chance, if the metrics, and again, same-store growth and invoice growth is, I think, the most important one for a public market. If that happens, and whether it's SVP, MVP, or VetCore or Veg, various folks will likely go public over the next 3 years, although we've been saying that for years, and no one's gone public yet. I think the public markets will be looking much more at organic or same-store growth than they will at acquisition stuff. All right, next question. I love the question from the anonymous attendee. Is there a number of desirable to national practice groups? Is the number of desirable practices lower? Could that be impacting the uptick in valuation? So this question is there scarcity value to good practices? And I think that the answer is partially yes, that there is some of that. So while, and the way I'll put it is, in 2019, 20, 21, a lot of 4, 5, 6, 7 doctor general practices and an awful lot of big specialty hospitals got sold. And so the number of big practices that are out there left to be sold has diminished. We are seeing insatiable demand for those types of practices. We're going to close on a deal this year at 15 times EBITDA. We haven't seen that since early 22. So there is strong demand. There's a piece of it that has to do with scarcity value. I am confident of that. But the reality is, at least what we're seeing is, there's still a bunch of them out there. There's just more groups looking to buy them than ever before. So it's not like there aren't a lot of independent 4, 5, 6 doctor practices out there. They're out there. There's just not, there's just more buyers than there are practices out there. So I think it's a good point. There is a scarcity value element to it that is important. All right. Any other questions that we've got? I'm waiting for the group. We've had 6 or 7 questions. They've all been good ones. If you go again to your Q&A and have questions, I'm happy to answer them. If if we're all questioned out, and which would mean I actually explain things really clearly and everyone's happy with my explanations, we can end the webinar. And so I'm going to give this about another minute to give the last stragglers a chance to type in questions before I cut this off. Dun, 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 dun. All right. Well, I very much appreciate everyone joining us tonight on a Wednesday night. It is a little dreary here in Pennsylvania, raining all day in the Northeast. Hopefully the weather's a little nicer where you are. Um, Wishing everyone a really happy and a Merry Christmas and a happy holiday season. I'm not sure if my picture that I drew was super rosy, but I think that there's a lot of opportunity in the current market for those who want to take advantage of it. If you have questions that you want to ask me directly, feel free to email me or set up a time to talk to me. And we really appreciate all of you showing up tonight. So thank you. Have a great night.